So even with the investors that I'm working with, they're all growth stage investors. Okay. And so, like you said, there is a role for philanthropy, there's a role for blended finance. And especially in Latin America, like there is a group called Gali that did research that says that uh, the there are lots of entrepreneurs in Latin America that are not investment ready by these big impact investors, and there is a need to conduct a lot of technical capacity building amongst these entrepreneurs to make them investment ready. So they have called out a role for accelerators like New Ventures to help these organizations raise capital. But I also see there being a very critical need for philanthropy to help these investors in the to help these entrepreneurs in the beginning to get them investment ready. So I just love for you to expand on all of that, like how you see the role of philanthropy versus blended finance by the larger impact investors, and what role you as an accelerator need to play to make early stage ventures like what BonBillo supports and works with who they work with. How do you get them investment ready?
That's an excellent question. And I think that's something that has to be asked from also the investors who are not, you're not able to allocate capital in earlier stages. That's a fact. The question is, how can you? Like it's not a statement, it's a question of, okay, I know I can't right now with the conditions right now. How could I? What would I need? Who could be my ally? And I think that's a question that you have to make constantly. So I think there's different levels on how this can work. From the technical assistant part, uh, we still see entrepreneurs who have the grit, who have great business models, but the training in speaking the same language of investors is not necessarily that deep. So maybe they do know their numbers very well, but they're just not organized in the way that investors like to look at them in an Excel financial model and projections. No, so I think it's meet me halfway. So investors, if this is important for you, help these entrepreneurs learn how and why is it important, and how they can incorporate it in the day-to-day life. It's as if that you organize your closet, but in a way that you never use it, so it's always going to be messy. Like, let's organize it, let's help you organize it, and tell you how and why is it important that you organize it that way, and in a way that it's practical for you as an entrepreneur to do so constantly. In the space of blended finance specifically, it's mixing different capitals. So it could be capital from philanthropy and commercial capital, which is the capital that you do have to repay with an interest and so on. And then you mix them and create a financial mechanism that has more flexibility in terms of risk, because it does not have to repay the whole thing as if it was only commercial capital, but it does have to repay, unlike the philanthropic capital that is does not matter if you repay. So it's a bit of their baby, and the way we're exploring this is we have done a blended finance fund. We did it as a relief for the COVID-19 pandemic. For many of our entrepreneurs were really struggling, and we knew that they were resilient enough to, keep on with their business with a little help. But maybe if they turn to a bank, the timing and all the paperwork behind when they got the loan or the credit or whatever, it would be too late. Or if they were looking for an investment, they maybe were too risky at this point to do to do an equity deal. So what we did is mix the philanthropic capital from a development agency, and then our commercial capital, which we had from our individual investors, and we mix them both together. And it's actually quite an interesting case because what we came up with was a revenue-based loan. And I know this is a new concept for a lot of people. So essentially what that means is that me as a financial entity lend you as an entrepreneur a certain amount of loan, and you're gonna repay me not with a fixed interest each month, but rather with a percentage of your revenue. So if this month, because of COVID, you had no income, then what you're gonna pay me is zero. But if next month you had double income that you had expected, you're gonna pay me a larger amount because it's the percentage, and that really aligns with the sales cycle of small and medium enterprises, because it's not linear, you know, it has like ups and downs, and if you as a lender have a fixed interest or amount that you have to that you expect them to repay, then you're also contributing at some point to that entrepreneur struggling more rather than growing. So that's what we do, the revenue based loans. And with the blended finance, what it allowed us to do is our interest valuation was less than the commercial capital. So it was even a more flexible, you had to repay us less because the philanthropic capital lessened the risk here when combined with the commercial capital. So that, and on the other hand, what we did is what it's called outcome-based financing, which is we said, okay, we're going to allocate this loan. It's going to be more flexible. It's going to be a better rate for you as an entrepreneur. You're going to pay it with a percentage of your revenue as your sales cycle allows. But also, there's a part of that loan, not completely, but there's a percentage of that loan that you don't have to repay me if you can prove that you can achieve certain impact milestones. And we have a third party that measures impact, giving transparency to this. So with them, there's a study of, okay, what makes sense in terms of what impact could be a good goal in terms of that you do stretch, but it is sort of viable. It's not something that you're never going to achieve in the time frame. And also measuring that it really, like if you say, okay, yes, I now empowered 50 communities of rural women, artisans, and whatever, let's prove that this is true. So it's quite interesting. And this is just one model, but there's social impact bonds and a variety of different financial mechanisms that come out of that blender. And I think it is essential to minimize the risk of commercial capital or traditional investments that, because of the analysis they have to make for earlier stages and the due diligence behind and all that, it becomes very costly to lend you or allocate capital in an early stage. And it's not even as attractive for you as an entrepreneur to take that. So it's not that great, but if you combine it with this government philanthropy or whatever, you're able to be a bit more flexible and meet you halfway again. And I think that has a great advancement that will be a great advancement for SMEs. And it's not only for blended finance, but also for financial instruments. As I was saying, we found that revenue-based loans are a great way for our region and that, but I'm sure there are many other instruments that are working for this specific stage.